Hey, audience and listeners, this is James Kandasamy from Achieve Wealth Through Value-Add Real Estate Investing podcast. Today, I have Dustin Miles from Dallas, Fort Worth area. Dustin is just so full of entrepreneurship. I'm going to go through in a short while. I know what are the things he did. I mean, he have done like almost $100 million in assets, 11 syndication, and he was known as the Candyman when he was age 8, and he sold some Pokemon cards, and all kind of things. He has been doing this for some time. So I'm going to get him to speak for himself on his on his journey until now. Hey, Dustin, welcome to the show.
Yeah, thanks. Thanks for having me.
Thanks for coming on. So why not you tell our audience about yourself and especially on how did you grow up being an entrepreneur? Because it looks like you have a lot of entrepreneurship signals when you were young.
I mean, my dad, owned a comic book store / costume store, so that I may have gotten the bug from him a little bit. But when I was a little kid, I had a candy business, and my bus driver called me the Candy Man. So I made about, I was 8 years old, made about $50 a week, and I sold Blow Pops, Jolly Ranchers, Laffy Taffy. And so I'd go by in my room in the corner, I had, boxes and boxes of candy, and then I'd take it to school with me and then, sell it while I was there. That lasted until the school told me that either they were going to kick me out or I'd stop selling candy. So I stopped selling candy. So I think it's just because I was closing in on their profits and their territory. But
you were competing with the school.
Apparently, yeah, and they shut me down.
So did you when did you realize that you have this entrepreneurship bug on adult life, right? Was it like you already know it as you're growing? This is how I'm going to be doing some business, or the revelation happened during your adult life?
There's a video of me and a friend of mine when we're about 7 or 8 years old, and we're talking about the businesses we're going to build one day.
Oh, cool.
It's kind of a little maybe abnormal, but I had a candy business. I bought and sold baseball cards, mowed lawns, whatever you could do to make money. I was trying to do it. And then I guess I was a weird kid. I'd ride my bike around. I live in Fort Worth. I grew up here. So I'd ride my bike around Fort Worth, kind of wondering, who owns all of these large buildings and all that. And honestly, I kind of assumed it was very large businesses. And then I played soccer with a kid that his family owned some of these large buildings. They owned a skyscraper, and I think they still own it today in downtown Fort Worth. And I remember, going to their house and seeing, the size of their house and all that. And so, kind of very early on in my head, I was like, hey, this is I was 8 years old at the time, but, in my head, I was like, if they can do it, they're normal people. They, put their pants on just like normal people. They can't fly or anything like that. But in my head, I was like, if they can do it, I can do it, because I was better than their kid at soccer. So
That's good. So can you give an advice for a parent right now? I'm sure a lot of parents are watching, listening to this YouTube or podcast, right? I mean, how would they identify the entrepreneurship in their kids?
Yeah, I mean, honestly, I would say it's a heck of a lot easier today. I mean, you can go be a YouTuber. I mean, there's Ryan's Toy Review. That kid's raking in 15, 20 million a year. So I would say it's easier than ever. But I would just I have a 9-year-old son, so I get it. I want to try and protect him from whatever some of the things out there and all that. But I would I guess try and help foster in a safe environment, help foster that entrepreneurial spirit. And whether that's, starting a YouTube channel, whether that's, making something and maybe, putting it up on Etsy, or putting it, or doing, buying products and building a brand and all that and selling it through Amazon. I guess I would just, encourage encouraged to help foster that where possible.
Got it. Yeah, it's interesting. I mean, me growing up, I didn't do like what you did in the beginning, but at some point, I think in my teenage life, I started selling buy wholesale and sell retail, and none of my friends were doing it, and I didn't realize until recently, oh, that's what I was doing. Okay, so I was like always trying to do business since early age. Obviously, you started much earlier, but I'm just trying to find out like how do we find that characteristics in our kids, because not everybody will be an entrepreneur, right? But there are kids who are born and who likes to do that kind of job, and just trying to like identify that early on so that you can foster them, right, and nurture them, that skill, right? So tell me about your journey in real estate. I mean, you're almost of like 100 million in asset, and you've done total 11 syndication. So let's start with your first real estate venture. Where did you get started? And I presume you had a W-2 job at that time. How did that aha moment came up?
Yeah. So I guess, but just a little bit before real estate, I'd read a book, and I like, as I showed, kind of always, been entrepreneurial, but, really the drive for passive income, started when I read this book. It was called Your Money or Your Life. And, quite the title, right? And so I read that in, probably 2008 or so. Before, I was interested in real estate before that, but once I read that book, I know a lot of people point to the purple book. I'm drawing a blank on his
Robert
name.
Kiyosaki.
Yeah, Robert Kiyosaki.
Rich Dad Poor Dad.
Yeah. So a lot of people point to that book as kind of the eye opener. So this Your Money or Your Life was kind of the eye opener for me. And I didn't agree with their premise. Basically, they were like, never buy a new computer, never go to Starbucks, like cut all your, slash all of your expenses and all that. And while I'm, I drive, I drive a Honda Accord. I'm not an extravagant, type of guy. That's just not for me. But, I believe in enjoying, some things too. I mean, I have a newer phone, and, and I like to travel and stuff like that. And, that was kind of an eye opener. Like I said, I didn't agree with the premise, the way they went about it, but I like the thought that, hey, when you're, kind of associating, really just paying attention to just being intentional about, developing that passive income was kind of, what came from that. But yeah, first real estate venture, I went through a few different real estate clubs. I was started out in single family, like a lot of other people. I went through a few different clubs, didn't really have a whole lot of success. We hired a few mentors, didn't work out. And honestly, kind of, was kind of starting to get fed up with it, and thought it was, thought maybe it was just a group full of shysters or something. So, but we went to a group. I went to Lifestyles Unlimited, and I I started out in single family there, and ended up making 50 offers on single family homes before landing my first rental. And so I got some sort of perseverance award through them. But, I ended up doing about half a dozen rentals or flips. And then I was like, this is cool, made a little bit of money, but this is a lot of work. I had, full-time W-2 at the job, at the time. And it was, anytime lunch breaks and weekends and my off Fridays, I was going to check on, the rehab process and all that. It was a lot of work.
Got it. And so let's go into your apartment. I mean, what is the biggest size apartment that you own right now?
228 units is the largest done. And so started investing passively. First deal I was passive in, I was a KPN 9 years ago, close to 10 years ago. And so did that. And then, and actually still in that deal today, which has been fantastic, just happened to buy at the right time. So that helps. But, I got into a few passive deals, and then I put together my first syndication in 2014. So it was 109 doors, and that was outside of Lifestyles. It was with another group, and so anyways, but part of that group and put the deal together, raised about 1.7 million, and we held that deal for almost 5 years.
Got it. So let's go into a bit more detail, right? So when you look at a deal, right, say today brokers are sending you emails, right? And what do you look for in that email?
I mean, honestly, before I'm really digging into the numbers, I'll kind of look and see, once I get the whisper and all that, I'll kind of just, hey, is it I'm going to use DFW numbers. If it's a C deal and they're wanting 120 a door, I'm probably going to quickly not look at that one.
Well, that's a reality right now, right? In Dallas.
Yeah, it's close. Yeah. Okay. I'm not paying, because you're
not the guy to pay for it, I guess.
Yeah, you're not too far away from what it costs to build at that point. So I don't subscribe to that. But anyways, so the first thing I'm really looking at is in the area, because you can put all this money into a property, you can put all this money into rehab, but you can't change the area, you can't change your neighbors, you can't change the school it's zoned to, and you can change maybe the tenant base a little bit, but the area is what the area is. And so really focusing on the area, looking at if I don't know the area really well, I'm looking at the crime, household income, I'm looking at the schools, I'm looking at Google reviews. Those are kind of things we look at initially.
So is there any turn off saying that, I didn't like, this one or two things and I'm going to shut down and look for another deal to come up?
Yeah. It depends on how far off it is. If it's, we kind of have a target household income. And so if it's close to that, we'll kind of keep looking at it. If there's we'll pull up some crime maps. If there's a lot of crime in the area, it's a no-go for us. We, just won't go there. So, but, if it's close on income and crime looks, favorable, and as in not a whole lot of crime, and the schools look decent, but maybe not, where we'd like them to be, then we'll go ahead and move forward. We'll go ahead and start looking at more.
What software or website do you use to check for crime?
Oh gosh, it's I think it's Community Crime Map, or I can't. Okay. I have it saved. I can't remember.
That's fine. So what do you look for in a crime? There's property crime. There's other crimes. Do you look for all crimes, or do you look for specific crimes? Do you look for frequency, or what do you look for?
Yeah, I mean we're looking at all crimes, but it obviously if there's some more harsh crimes, murders or shootings and things like that, then that's a no-go pretty quickly. So, but if it's, for instance, close to a mall, the likelihood that there's some theft going on there is going to be fairly high. So we take things into consideration. It's not complete. There's a theft over there. We're completely done. We kind of look at the whole story and just see what makes sense.
Got it. So let's go to household income. What household income do you target, and why do you target that?
We're around the 75K mark with that. And it depends on what metros you're in, right? If you're in LA at 75K, that's it's very different than DFW, or Houston. We're kind of looking at that is the average, that not the median, but so we're looking at that. That helps, sometimes, not always, but sometimes that is an indication of sometimes what schools look like, but in general, we want to make sure that people are making enough to where, because we're more focused on in the past it's been more BC, we're looking more AB now, and we want people that can afford those are higher rents than your CB, particularly your C counterparts, or at least they should be. And so we need folks that can support those rents.
Yeah, that makes sense. So you're looking at Dallas, is that right now?
Probably our main focus is Houston, DFW, and then Austin, San Antonio, in that order.
Okay. And why are you not looking at Dallas anymore?
We're looking at DFW.
So why did Dallas drop into number 2? Why Houston? What do you see in Houston market?
The cap rates in general are a little more favorable there. Houston generally lags Dallas in terms of cap rates. If you look at the CBRE cap rate survey, you see the same thing. But DFW is seeing, but actually all markets, from what we've seen, we're seeing cap rates compress even further. So, but the reason why is we just see more opportunity down Houston right now. We think there's we just think that there's just more opportunity, and part of the reason why is down in Houston you're not seeing kind of some of the larger players, some of the Wall Street folks are not in Houston right now, and so we think that's kind of given us some opportunity to pick up some deals.
So Houston is a tricky market because there's no zoning, different sub-markets are different, right? So How do you, let's say today you get a deal from an email from a broker on a deal in Houston, what would you first look for?
It helps that my business partner's from Houston.
Oh, good.
So I'll say that's kind of, probably, part of our secret weapon. And then we have his parents are still down there. He's up in DFW, but his parents are still down there, so that helps a lot. And then our management company is based in Houston, and so that helps a lot. We can call up a regional and be like, hey, what do you think about this property? And so we've been working with them for quite a while, but I would say we know a lot of the areas well enough. Of course, before we offer and all that, we want to go take a look in person and all that, because you can only see so much from Google Street View. When we first get a deal, we pretty well understand whether it's a deal that we would want to be in or not. And plus, we can, the broker is going to put, they'll put, and we'll pull up the crime, we'll pull up the address, we'll look at the crime statistics, and then we'll be able to know whether that's a deal that we want to, potentially be in or not. So.
Got it. And do you worry about some of the flood zones in Houston? Do you check for that?
Oh yeah, absolutely. Well, and you can typically see that pretty quickly on their P&L. Just look at the insurance cost, and then you can, this is in a flood zone, and that one's not. So that's okay. Part of the criteria that we look for. We don't want to, and the Houstonians kind of poke fun at us that we don't want to be in the flood zone, but
they're so used to it, I guess.
They're so they're that's how they tell that people, because they get a lot of Dallas buyers and stuff. So they go, well, you're obviously from Dallas. So.
They say we all swim here, right? All our residents are trained to swim. No worries.
Right. Yeah, everybody has a boat.
Our apartments float when it floods. So not a problem. We'll just buy more insurance. Flood zone, if you're used to it, you're okay with the flood, and if your investors are okay, probably it's okay.
Yeah. Well, it's tricky because some of the complexes didn't flood because of Harvey or because of the flood. It flooded because they let some levees open. Which is, and then there's lawsuits around that, right? So it gets tricky, but we're not wanting to be in a flood zone, and even, like the deal we just closed 2 months ago, it's not in a flood zone, but we went ahead, and flood insurance is super cheap if you're not in a flood zone. So, but we went ahead and bought flood insurance just in case.
Yeah, just in case, yes. So market is so hot right now. You're still looking for deals. Are you doing anything differently to get deals in this hot market?
We talked to a lot of brokers, and because we just closed a deal pretty recently in Houston, we kind of put us on, I guess, some preferred list. And so, we're getting some early looks on deals. We call brokers pretty frequently. Hey, what you got down the pipe and all that? Is there anything we can drive? Is there anything we can underwrite? So, I'm sure that's what everybody else does too, but we're frequently contacting, brokers brokers and, and sometimes even talking to our management company, hey, because they manage quite a few deals down there, hey, are you hearing anything coming out soon? Let us know. So yeah, we're always, or, we're also talking to our mortgage brokers, that work down there. Hey, do you hear, are you hearing anything that's coming out? So we're always, trying to go through kind of some unconventional avenues to see if there's some deal flow coming up.
Yeah. And you said our management company, do you do your own management or you do third party? Just they're based?
No, we work with a third party. Yeah.
Okay. They're just based out of, okay, got it. So let's go to a bit more personal side. I mean, you have your whole life, you've been doing a lot of entrepreneurship and went into W2. Now you are full-time doing this, right? Was there any specific moment throughout your real estate career that you are really proud of and you can never forget about it? Something that you're going to tell your grandkids.
Yeah,
that I did that.
I don't know if I really have one of those yet per se. I mean, it was, I guess there was one deal and our returns were not stellar, but I was really proud of the fact that it was a hard deal and I put a lot of effort into it to make sure it went well. And we had no cap rate compression at all. So, this is in Oklahoma. We ended up, investors and ended up netting, like I said, not, I think it's good return, especially now, but they ended up netting a 65% return over about 3 years, 3.5 years. So a little under 20% per year. But we bought it in 8 cap and we sold it in 8 cap. No cap rate compression. So I was pretty, I was pretty excited about that. I mean, I've had some other deals where we've had plenty of cap rate compression, 2 and 3x, right? But there was no cap rate compression there. And it was kind of, honestly, we had a really tough time. That was one deal that really taught me about location. We had a tough time moving the rental income. We instituted billing back of water. We did water conservation as well. And then probably the biggest thing that helped move the needle was they had not just a basic cable contract, but they had extended cable. So it was, I forgot how much the property was paying per unit, but this extended cable rate retailed for like $60-$70 a month is, quite a bit. And they were giving it to the residents for free. And if that was the market, cool. No one else was doing that. So, and I knew when we were underwriting it, when I was underwriting, I knew when it was going to end. The cable contract was $42,000 a year. And if you divide 42,000 divided by an 8 cap, it's over $500,000 in value. Well, the raise was 1.5 million. And so, made a 30% return on doing nothing, basically just, me just signing something saying we're canceling this contract.
That's awesome. Yeah. So I want to make sure the audience and listeners are clear when you say there's no cap rate compression. You bought at 8 cap, you sold at 8 cap, which means that 65% that you guys have made in that deal is purely value add by your own sweat equity, right? And that's something that, I want to make sure that we delineate from a lot of people who said I made 2x, 3x in the market because a lot of it's cap rate compression, right? It's maybe not their own effort.
Right.
That's just pure luck, right? And what you did is not pure luck. It's basically, your effort and your team's effort, I guess, which is a really good thing.
Yep.
So tell us about your website and how can our audience and listeners reach out to you?
Our website is momentummultifamily.com. My email is just dustin@momentummultifamily.com. And, we work on, just educating folks, just trying to, add value in the marketplace, similar to James. And we were honored to have, before the pandemic and all that, we were honored to have you come up to Dallas to speak. So that was a lot of fun. Well received. A lot of people came out to see James. I think we had over 100 people. So so good turnout. But yeah, that's kind of me in a nutshell. And yeah, live in Fort Worth, but went to school in your neck of the woods, went to UT Austin. Austin.
Oh, cool. You're Austinite, right? So when you're talking about when I came down to Dallas to talk in your event, I was just surprised to meet some people in that event who I've never met, but they say they already know me because of my podcast. So all the people out there who are listening to my podcast, hopefully one day we meet soon, and make sure you go and share the podcast and, give some comments on YouTube or iTunes when you see it for the podcast, so that at least we know that someone is listening to my podcast. Awesome, Dustin. Nice chatting with you, and thanks for coming on to the show.
Absolutely. Thank you. Appreciate it.
Bye.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.